Hi everyone, I'm Darren from Investing Note. So once again, welcome everyone to attend our webinar for today. So let's start. So before start, today's topic is how do you manage your portfolio during a bear market. So before we start the talk today, so let me share something about what actually is Investing Note. Okay, please hold on. Let me share my screen. Okay, so you guys able to see, right? Okay, so investing node basically is a social media platform for investing community. So it's just like Facebook, but it's more focused on investing community. So a lot of user they come over here to share their ideas, share their investing analysis, and all about this. So what you can do in our platform is you can come and share your thoughts as well, and all the features here is free and you can use it. So let me share about you a little bit on our platform. So you can see here, this is one of the this is a demo account. So in here, you can see there is the different tabs. Then after that, there is a different post over here you can see. So for investing, no, doesn't really like English. You can type is in Chinese as well. So over here is a Malaysia channel. If you're interested with other channels as well, you can just change to Singapore, or you can change to other country as well. Okay, so for example, like this one is Singapore channel, US or Hong Kong, or everything. So you can see different type of posts from different country. Okay, so there's another thing is estimation. So this estimation is features that we allow the user to do some estimation on some stock. For example, like this one is a Singapore stock. Let's try for Malaysia. Okay. Okay, so for example, this post is saying that, okay, Asia. So this one is just an estimation. Okay, it's not a call or a sell call or buy call. So it's just an estimation. So for the next 3 months, what is the target price? How much is going to go down or go up? So it basically is just an estimation. Okay, so in our platform, there's a index over here. You can see we have STI, KLCI, and Hong Kong Hang Seng. And we also have a stock page. So over here, there is a US, Singapore, and Malaysia stock page as well. So you can come and see there's all this stock data, everything is here. And we have a charts. So for these charts, you can do some technical analysis. So for example, like you can put some indicator. So for example, let's try a moving average. So you can just type. Okay, so after that, you can change here. Okay, so change to 20. Okay. So you can see the line, the moving average line. So then after that is a watch list. So inside this watch list, you can add whatever stock that you want to put in. So okay, so another one is portfolio. Okay, this portfolio is just a tracker. It doesn't link to your transaction account. Okay, it's just a tracker. So you can track your portfolio over here, and it's all the summary, the transaction, what's transaction period you buy or sell is all here. So very easy. Just add a transaction over here, or you deposit or withdraw. Okay. Another one is alert. So this alert is you can create some price alert or an event alert. So for example, like okay, so for example, I want to do a price alert on Hong Leong Bank. Okay, so select some conditions above, so value like okay, 15 for example. Okay, so just save. Okay, so you create here, so you're going to alert you when hit this price. Okay, so it's an event alert. Event alert is the alert when for example, like some of the company you wish to receive some alert. For example, like Asia, you want to receive like company announcement, corporate announcement. Okay, then just click. Okay, it's here. Okay, so this is our platform. Our platform is free. It's a social media platform. Everyone can use. Okay, so thank you for waiting. So today, because of the okay, just hold on. Let me just change back to the screen. Okay, so today, welcome everyone to join us in this webinar. So today you can see the virus is hitting us so badly and the economy is going down. So today we invited Joo Parn from Kaya Plus to share with us how do you manage your portfolio in this bear market. Okay, so hello Joo Parn, are you there?
Hello, I'm here. Hi,
Okay,
Darren.
so, hi. So I'll pass the floor to you.
Thank you very much.
Okay,
So, hi,
yeah, it's all your
everyone.
time.
Thanks. So, hi, everyone. How is everyone doing? Pretty good. So, just a show of hands, we have around 36 participants today. So, where are you from? Are you from Malaysia? Are you from Singapore? Let me know, check me out. Personally, myself, I'm a Malaysian, but currently working in Singapore. So, I'm not locked down. I am still traveling around, working around in Singapore, but with the so-called control shopping malls open and close at a certain time, and we are now at a very interesting part of our lives where we are looking at COVID-19 giving us a very big headache and impact to our lives. So of course the question that people want to ask is, during this kind of situation, what should we do with our investments? Like, we have been investing for quite some time, and suddenly out of the blue, this virus became more and more serious. And so what should we do? Should we cut loss? Should we buy more? Should we wait until everything is has passed? Only we choose to do what we want to do. But so what is the thing that we should do at this time? So I will be sharing my personal thoughts. You can also let me know your comments. So without ado, let's go to our presentation of the day. So before we start, a little bit of disclaimer. Okay, here we go. So during this fast, brief presentation, we will be using real-life companies as examples only. So do not take it as a decision to buy, sell, or even cut loss. If you need any advice, do seek for professional advice. And on our side, Investing Moat and Kaya Fast will not be responsible for any decisions you take upon you finish this presentation. So let's move on. So what is happening now? And it's the bear market. So the bear market was actually officially announced that has started in early of March. So at that time, most indexes around the world has crashed more than 20%, which actually qualifies it to be called or entering the bear market phase. But the bear market itself is the result. What causes the bear market should be the questions we are asking. So there are two major events or major situations that's currently causing the current bear market. Of course, COVID-19, the virus that has spread over the world, has caused a lot of headaches, has caused a lot of problems, has even made people out of jobs, quite major problems. But on a bigger scale, because of COVID-19 hitting the world hard, China, especially the first country to be severely impacted by COVID-19, saw a decline in their crude or oil demand. And when the demand goes down, OPEC, which is most of them are derived from the Middle Eastern countries who are oil producing countries, they decided to control the oil price to lower down the output to stabilize the supply and demand curve. But Russia, being another major oil player, decided not to listen to them, continue to produce oil at the level that they deem is right. So this got OPEC and particularly Saudi Arabia very angry. So they engulfed in a crude war price war. They drove the crude price down from $60 per barrel to roughly $20 per barrel. So it's roughly like a 60% decline. And coupled with that, it threw the market off guard, and people were starting to panic. So what happened? But before that, just the latest guesstimation. As of now, what is the COVID cases around the world? Anyone can give a guess, or anyone has already saw the number. So you can share with us if in the chat box how much cases are we currently seeing COVID-19 impacting us. Anyone with an answer? 700K, yeah. Shenison has replied, quick hand. So around the world, COVID-19 has actually impacted 700K. In fact, it's close to 800K. The number is around 789K as of it has gone up. It's roughly 799, which puts us a whiskers away from 800K. To put things into perspective, the last epidemic that we are very fond of or still have quite faint memories of was SARS. And SARS only garnered 4 digits. The overall SARS cases back then in 2008 was roughly 8,000 cases. So you're seeing 100 times more COVID-19 cases compared to SARS. So it's more serious, it's more scary. Of course, the fatality rate is not that much, but that doesn't mean we have to be at ease. We can still undergo our normal lives as per usual. So how has the two major events caused or affected the markets around the world? So the first slides there you can see is the US Dow Jones. Dow Jones actually corrected close to 30% as of from a peak after COVID-19 became a major pandemic over in the US, coupled with the oil price war. Next, close to Malaysia, we see our KLCI index also correcting down, also close to 30%. And last but not least, I think we also have a Asian neighbor, which is the Hong Kong Stocks Index. So if you just look at all the major indices around the world, be it US, be it in the Asian, be it in the Euro as well. So the sell-off was pretty much, everyone was impacted, no matter you invested in US market or in the Europe market as well. So your share prices in your portfolio will have seen, we have seen the same decline. But this is just what has happened during this brief 1 month, ever since the COVID-19 became an epidemic and severely impacted stock market prices around the world. But let's look at the longer time frame. What did the indices look like if you started invested 11 years ago and your results as of today? So you see the Dow Jones is actually still up. If you started invested 11 years ago, you will still be sitting on a very happy gain of roughly 30%. KLCI, if you invested 11 years ago in the correct stocks, you also would be sitting on a bit of capital gains. You will not be seeing your portfolio showing you negative 30% of losses. And if you chose to invest in the Singapore markets, fair enough, you are still sitting on a healthy gain on your portfolio. And last but not least, even if you're invested in Hong Kong, you are still seeing some gains in your portfolio should you have invested 11 years ago with the right companies. So what is actually, what can we actually learn is that the market will always fluctuate without any conscious, without any reason or without any logic. At the current time when there is news, whether it's a favorable news or unfavorable news, the market price will always fluctuate. But the essence of the indices, which represents good companies, these businesses that a company do, they won't be much affected or they will be minutely impacted. So once the epidemic passes, things return to normal, these companies will continue to earn more and more revenue and increase their profits from them. And share prices will also tag along. And this is why you see, if you look at indices or even good companies with a historical price of 10 to 11 or even 20 years, share price will eventually go up. And even though current correction will be huge, 30% or 40%, if you've invested back then, you'll still be seeing a healthy capital gain, or even you'll still be receiving decent dividend yields, because the company has grown so much bigger, and they are able to afford to pay you what they earn without any major impact, even though whatever crisis there is. So moving on, you see that even though COVID-19 is the talk of town as of currently, historically, this is not the first time we are facing pandemics. So from here, you can see that even in 1980s back then, when HIV/AIDS actually appeared and got recorded on its attack and potential effect on human beings, share markets still eventually trend up. And then roughly in 1994, you see the pneumonic plague also heavily impacted, causing health problems, even causing deaths to humans. Still the share market went up. And along the years, you have SARS, you have avian flu, you have dengue fever, you have big and small different kinds of different impacts of epidemics happening. But eventually, we have managed to brave it through, and good companies, components of the indices has also trends up higher and higher. And you never see the indices going down to historical prices back in 1980s or even in the 2000s, because companies will tend to perform and perform on, and the near-term fluctuation will just be a short-term distraction to us, to put us off our guard, to actually maybe impact our strategy when it comes to investing for the long term. So what should you do now? Before I answer this, maybe you will let me know that what are you thinking right now, and what is your feeling right now, and what actions maybe have you taken. As of now, I think the market has been recovering 20% or so. Just if you based on the Dow Jones index, it has corrected from the so-called bottom up 20% as of last week. Of course, I have heard people saying that they have cut loss, they also have taken profit. But what have you done ever since the crash and the minor correction upwards? Anyone would like to share? So even now, even though the market has corrected upwards of 20%, we will see, because we are so connected to the social media. Of course, investing is a topic. If you go on your social media, be it Facebook or Instagram or even Twitter, you'll see individuals who making their point. Of course, people are calling to sell on the correction to minimize the loss. And there are also people asking to buy because it's still a very good price. It's still a bargain, and the long pathway, eventually, when everything settles, when the epidemic dies out, you'll be looking at the longer and higher potential gain should the share market trends up eventually. So everyone has a point. At the end of the day, before you really ask yourself, what should you do in this current situation on this bear market? Perhaps you would need to ask yourself, who are you? Are you an investor? Are you a trader? Or who are you? What is your strategy? So I find this topic very interesting, because people always like to ask what to do. But essentially, it boils down to what you are. And what you are determines what you're going to do. So to put things into perspective, or to make it now very simple, we always remember last time when we were still young, computer games was one of the ways to pass our time. And of course, in computer games, there are some genre of games where you actually take up a specific role, whether you are a warrior, whether you are an archer, or whether you are an assassin. So different characters have their pros and cons. Warriors have higher HP, they do higher attacks, but they are slow and hard to train at the beginning. Archers, on the other hand, they are swift, they can dish out very fast attacks, but they have very low HP. But on the other hand, they are also very fast in terms of their movement. And for assassins, usually you guys rely on luck, you rely on speed as well, and you also don't have much HP. But eventually, when certain characters, all of you reach a higher level, you all have your different skills, you all have your different equipments, you all have your different damage, how you deal with damage. Warriors will do damage per hit, while archers and assassins will deal with based on damage per second. So it boils down to what you want to be. So are you going to be a dividend investor? Are you going to be a growth investor? Or are you a trader? Because essentially, the pathway you choose to invest or to trade in the market will determine your strategy. So for a value investor, what should you do? A value investor will always look for good companies that has fantastic business model. These companies will actually eventually grow bigger and bigger, earn more money, earn more revenue, and buying it today would only make very good sense because 10 to 20 years down the road, these companies will become so big and the earnings that they deliver would actually give you multi-baggers in terms of share price or even out of the normal range dividend yields. We're talking about 10%, 15%, or even 20% 20 years down the road if the company grows that well. So, of course, to actually come to notice companies like that, you also have to have the insight to know how this company's business model will fuel the growth 10 to 20 years down the road. Because some business models will only make sense 5 years or 10 years, and this company would find it very difficult to grow beyond that time frame. So, of course, each business comes with their risks, and as a value investor, you will be looking at what are the risks that this company will be facing near term, medium term, and longer term. Does this company have the competent management or even the balance sheet strength to weather through any problems, any liquidity issues, or even the current pandemic? So now it's a very good time to actually ask yourself, look into your portfolio and ask yourself, this company that you invested in, now there's a lockdown in Malaysia, and company also have abided to the MCO and stopped business for 3 weeks. Does this company, or is this company able to sustain giving up salary, not doing any sales? Do they have a robust balance sheet to withstand the ongoing challenge in terms of cash flow? And not also that, you also have to learn how to value a company, determine your entry price, and apart from just focusing on the company itself, value investors, we have to actually weigh our cash to investment management. How much cash do you need to hold on hand? What are the opportunities ahead? Do you invest 100% or do you invest just 50-50? Different economic cycle calls for different cash to investment ratio. So that determines how much investments you are willing to hold, how much cash you're also willing to hold on hand to take advantage of any downturn in terms of share price or also economic downturn. And last but not least, value investors, we have the skill of managing our portfolio. Every now and then, you have to relook into the companies that you've invested. You have to take note. Let's say, for example, company A, you invested it 1 year ago because of this reason. After 1 year, has anything changed? Did the company come across any surprise, unwanted challenges? And is the company able to solve this or go past these challenges? If no, you might be thinking of cutting or reducing your position. Or if the company is still in very good shape, you can continue to hold on to the company and let it go further. But for traders, all these strategy, all these advices that make sense to an investor, it doesn't make sense to you because traders will usually look at counters or derivatives that has high volatility. So they don't really need to keep track of how the company is doing. They just need to look at the chart patterns, look at the price volume actions, and they determine their entry price, target price, and also cut-loss price. So they rely heavily on chart pattern mastery. They need to know how to read the charts and take advantage of any breakout to take a good position before the majority of the shareholders or other people come into the shares. And they have to have strict cut loss and take profit strategy. And for traders who are using margin financing, you also have to have a skill or have a hindsight of managing your equity and margin financing well, because eventually if you fail to cut loss, you will be losing you're losing more than what you put inside your account, and that is where your broker will call you up and give you a margin call if you don't top up, and eventually you will lose more than what you put inside your account. So personally, I am a value investor, so I will be talking more today on how to take advantage or how to tune your mindset to be a better value investor during this bear market. So what is the game plan of a value investor? Value investors, or most investors, we always like this word. This word actually is always a question that we ask every time someone asks us about a company. And this word is called moat, economic moat. So what is a moat? Moat is actually the lake you see now in the picture, where it surrounds a castle. So during olden times, where there's a lot of war between countries, how kings or lords protect themselves is they build castles with high walls. But castle with high walls is just not enough. They need to prevent enemy armies from going close to the castle. So what they will do is they will dig a lake, fill it with water. Sometimes they will also have crocodiles or other man-eating animals inside the pond or inside the lake to prevent people from attacking the castle. So Warren Buffett is actually the investor who coined the term economic moat. Is that every time he wants to invest in a company, he will always ask himself, what is the advantage this company is? Can this company defend itself if there's an attack coming or threatening the company's business? So if this company has a very strong economic moat, then it makes sense for him to invest. And of course, this theory, this principle actually makes sense to a lot of investors. And like me personally, also, we have also adopted his methodology when it comes to investing in companies. Every time I want to invest in a company, I will always ask myself, what is the economic moat? Is the company's economic moat strong enough? Can it withstand any challenges or threats that comes eventually? So what are the examples of economic moats of a strong company? Or before that, how do we actually categorize the moats of a company? Is we can break it up to 6 points. So as of currently, when we have COVID-19 impacting the share price market, one very good way to look at a company's moat is, as of currently, is the company's businesses impacted or not. So if you see at the column there, you see there are only 3 scenarios. Either the company's revenue is impacted in a positive way, in that sense they are gainers, is impacted in a negative way, and in this case they are a loser, or nothing impacts, so not impacted. So day in, day out, the company is still running its business. It's not surprisingly outstanding, nor is it losing money by not doing any sales. And also we have to look at it at a shorter term and long term. So for companies whose business is not impacted by the current COVID-19, so in the short term and long term, you would have to look at the fundamental value of the company. Is the company going to grow regardlessly of the challenges, be it COVID-19, be it financial bubble burst, or whatever challenges that lie ahead? If this company is so sound that any challenges or problem that comes in your way and also won't impact it very much, then it makes sense for you to actually keep a closer look at these kind of companies, because these companies are what we call recession proof. Whatever comes in their way, they will still earn more money. And later we will share with you what kind of company that has such so-called special business model. Next, we go on to the companies which are gainers in the short terms and also longer terms. Of course, short terms companies like our glove makers who currently are working 24 hours, running day and night to address the supply, address the demand of the gloves around the world. Malaysia, as you know, produces around 60% of the global gloves consumption, and we have big glove manufacturers here like Hatta Lega, Top Glove, Kosan, and also Supermax, who are the top big four biggest, and they themselves are actually one of the key contributors to the gloves that everyone uses around the world, day in, day out. On a longer term, these kind of business models are companies that could be the trend changers. Like for example, now that most of us Malaysians are at home, being forced to work from home, of course, there are tools and apps that help us out during this MCO time. You have companies in charge of apps, softwares that communicate with your colleagues, even though that you're not in the same workspace, but you're working from home, but you're still able to finish your job day in, day out without any delays. So these are companies that could eventually become trend changers, and the current COVID-19 situation actually just helps to make them shine. Moving on, we also have companies with business models which are losers. It impacted very negatively, but just for short term. Example, our airline companies, most airline companies currently grounded their flights, canceled their flights just to curb the spread of COVID-19 around the world. Back here in Malaysia, of course, AirAsia, a listed budget airline, stopped all their flights, and they are one of the companies facing major challenges when it comes to settling their near-term obligations, because no money, if they don't earn any money, then they have to find some way to pay off their borrowings and also the salaries of their staffs. On a longer term, companies that are at the losing trend. For examples, what I could think of is companies who are involved in the retail in the US, like shopping malls in the US, which are severely impacted by just COVID-19, and also Amazon, which has made online marketing and online selling so much more lucrative and so much more fun compared to traditional brick and mortar malls back in the US. So US malls, US REITs are the so-called examples of long-term losers when it comes to assessing the economic mode before you eventually choose to invest in a company or not. So examples of good economic modes are companies involved in the food and beverage manufacturing. In Malaysia, we have a few key players, and also everyone should be familiar with them, as they are the most expensive in terms of share price. We have Nestle Malaysia, who is a major food manufacturing company listed. You also have Dutch Lady, you also have F&N, and the next company which has strategic economic modes, or under our Prime Minister Muhyiddin term as essential services, would be the banking. So even though the current lockdown in Malaysia impacted a lot of companies, but there are still some companies categorized under essential services. They still manage to run their business as per normal. Even though it's COVID-19, or even though it's financial crisis, people still need to eat. So people will still shop for food and beverages product. Even like Malaysians now, when you queue up to enter the shopping mall and to get your groceries, foodstuffs, yeah, essential services, and eventually companies like Nestle will still earn money during this time of period. Banks like Maybank, CIMB, or even in Singapore, DBS, UOB, OCBC will still be running their loans, borrowing out money, collecting payments day in, day out. There's no impact to banks' business day in, day out. Next, we go on to companies which are very strong in trademark. Companies like Disney, who have multiple trademarks over their films, like Star Wars, Marvel. So once a company like Disney has a trademark over a certain movie, they can sell the trademark or sell the IP to other companies to be made into toys, to be made into theme parks. So they can, just based on one brand itself, they can replicate the brand into different products. So this is the power of trademarking, and a company like Disney actually exhibits a very good example of how having a lot of trademarks, a lot of brands that they control and no one else can control, and eventually grow their business from just plain movie making into building theme parks. And also, as of currently in the US, they are also slowly going into the on-demand streaming platform under Disney Plus. Moving on, also you have companies who are the companies in charge in utilities, like water and electricity is still an essential. You could also argue that internet is also an essential now that the government of Malaysia also gave Malaysians complimentary free internet. And of course, moving on, last but not least, is also our tech companies or the software companies. So these companies develop software apps that are not tangible products. They don't make us full. They don't help us settle our loan. But somehow, or rather, we always log in to these apps. We connect to our friends using Facebook. We view photos using Instagram, and we communicate with our friends and families through chat under WhatsApp. We watch videos in YouTube. Why do we do that? Because it's a way of life. Somehow, along the years, people have slowly begun to be more attracted or be more glued to their phone screens, and these are the apps that actually help companies like Facebook or Google, who are actually in charge of YouTube, to be earning more and more revenue through their platforms and through their apps. So, of course, companies or indices, major businesses around the world has also seen a decline in the share prices. I would say more than half or even close to 70% of companies all around the world are in the red. Appears just because they are facing the headwinds of COVID-19 and also the price war of the oil prices. But of course, there are still opportunities out there. There are still companies that are actually performing very, very well in terms of share price and in terms of future earnings, because the current locking up, forcing mandatory movement control on the citizens does actually help certain businesses to flourish and grow. So you have this company within the past 6 months, from a share price of roughly 250, it has shot up to close to 350. This is a very well-known company in the US, and they also have their services available in Malaysia already. It's a streaming device, movie on-demand streaming device. It has even substituted Astro Malaysia, which has passed in the so-called on-demand streaming platform or subscription service. But as of now, if you ask most of our friends and relatives, they have subscribed to Netflix, which offers them latest movies, specially curated movies, and also documentaries and other sorts of programs as well. Another company also which has performed significantly well and surprisingly well, because I think as of now it has gone up 100% in terms of share price already. Because just out of the blue, 6 months ago you would not have heard about this company, but currently this company is so famous that you are also currently using the service of this company. This company is Zoom Videos. So Zoom Videos offers video conferencing services. It allows companies where employees are in the midst of a lockdown to still communicate effectively, hold meetings smoothly without any lags, without any latency problems. So these are companies that actually flourish and see share price increase because people expect their earnings to be better and better just because we are forced into a lockdown and their products and services actually thrive during the lockdown period. Of course, coming back to Malaysia, where we're currently at, we also have examples of companies doing pretty well during the lockdown period. This company has gone up from roughly 5 ringgit to close to 7 ringgit as of last week. I think this week it should be higher. This company is none other than Patalega. They are a major glove producer in Malaysia, but also supply majority in all around the world. And I think in terms of efficiency, in terms of pieces per minute output, they are the fastest compared to Top Glove. And not to also mention, apart from Patalega, the smaller glove makers like Kosan, they are also flourishing due to the current epidemic, where people are asking and demanding for more gloves. And so if more gloves eventually translate into more sales, and more sales will translate to more profits, and hence it is normal that share price tag along. So after going through this so-called brief presentation on how actually value investors should react to take advantage of this current share market crisis, it always will make sense to buy on the dip and buy when there is a sales. And I think we all who are, so for value investors who are very loyal followers of Warren Buffett, we can recite his quotes in the back of our head. Price is what you pay, value is what you get, and you have to be greedy when others are fearful, and fearful when others are greedy. So if all of this eventually makes sense, and coupled with the examples and the scenarios that I showed you, that eventually epidemic will pass and share markets will eventually go up again, then you'll be very intrigued to know that, okay, so eventually if share price is going to go up, so when should I buy? Of course, I need to buy at the bottom. The more bottom it is, the more I buy, eventually I would earn more when the share market rebounds and go up higher and higher, since indices or good companies will always go up. But here's the thing. No one will actually know when the bottom is. Even me, I also don't know. You ask me, I will also never know when is the bottom. If you ask Warren Buffett, he will also never know when is the bottom. But what we can do is we can do dollar cost averaging. If today's market price is a fair valuation for this current company, you need not spend every single cent you have to buy this company. You can split up your purchase to 3 or 4 tranches. So you can allocate 20% of it or 30% of it. Then along the road, if things turns bad, turns serious, turns worse, but there is no problem with the company in terms of business, in terms of liquidity, in terms of balance sheet, then if prices correct downwards, it only makes sense for you to buy your second 30% of it. And worst case come to worst, if things don't turn up to be better and it goes down worse, but still the company maintains its strength, maintains its businesses. So you would take your final allocation, budget allocation of this company, final 30%, and then you buy the remaining 30% of it for this company. So eventually you'll be buying this company in 3 stages. And these 3 stages, every time you buy, you're buying it at a cheaper and cheaper price. So eventually, once you finish your allocation, all you have to do is just wait. And if nothing is wrong with the company, and if everything eventually becomes better when the epidemic stops, when share markets rebound, this company will also eventually rebound. And when this company rebounds, you are actually going to maximize your gain, because you will have better lower averaging buying price, and then if the market goes higher, share price climbs higher, you'll be sitting on a bigger gain. So it makes sense to only take any actions as of the current day based on your strategy, and not to actually wait for the bottom, because no one will actually know when the bottom is. So just a brief roundup of this short presentation. Investing is still a legitimate way to preserve and grow a wealth. You've seen from the graph, you've seen from the major indices, eventually price indices will go up, and these price indices are made up of companies which have good business model and still be able to grow 10 to 20 years down the road. So if you invest it in this company today, it will eventually compound your wealth and your investment returns 10 to 20 years down the road. Pandemics comes and goes. this is not the first time we have faced life-threatening diseases. It will be tough currently, but it won't last. And eventually, God knows, 5 years, 10 years, or 20 years down the road, we might be facing another pandemic which is more severe and more serious and more scary than the current COVID-19. But as times also goes by, science and technology and our advance in medical would also help us win our fight against more challenging diseases. So pandemics will come and go, but tough companies and tough investors are here to stay. So whether is it a time to buy or to cut loss at the current time of period, whether you are a long-term value investor or you are a short-term trader, you only have to ask yourself this question. Does buying a company, great company at today's discounted price make sense 10 to 20 years down the road? Or is the current volatility something you can take advantage of if you are a very good trader? Value investors like us should be focusing on quality businesses and taking advantage of this current bear market. If a company is so good and just because people are selling it now because of pandemics, sometimes the pandemics don't even make sense, like Nestle Berhad. They are still earning money. People, when they go to groceries, they go to supermarkets, the first thing that they want to buy a lot, stock up is instant noodles, Milo, because these food stuffs can be stored for a very long time. But still, companies like Nestle Berhad, they still face a sell down. Companies like Facebook, who are in the social media business industry, nothing to do with having any stocks in the supermarket to sell or buy, but just because everyone is going down, because every stock is facing a sell down. Facebook also got sell down from $200 to currently $160. So it doesn't make sense. And when you understand how irrational the market price is, it's up to your decision or up to your strategy as a value investor to take opportunities of this fluctuating price to get a good company to invest in. And last but not least, no one will ever know when the market will bottom. Sometimes bottom will have a deeper bottom. So it only makes sense to strategize, to split up your purchases into a few tranches. Once the current price is a deemed fair valuation for you to buy a company, you would allocate maybe 30% of it. If it goes down small, another 30%, and it even goes down small, you allocate your final 30%. So this is how you actually take advantage of the market conditions, which we won't know will go up, go down, or stay flat. We can only react based on the current market price when you look at your screen. And that is the thing that actually matters, because a lot of times we tend to wait for the bottom, and eventually when share price rebound, we are left with nothing. We didn't manage to take any advantage of the grand sales because we were waiting for a better and better opportunity. So that rounds up my simple and brief discussion on how you should react or how to manage your investment portfolio during this bear market. And if you are a value investor, of course, you'll be seeing some capital losses floating in your portfolio. But if these companies are good companies, it doesn't make sense for you to be scared, because eventually when things become better, so will this company. And hold on to it if it's a good company, and you will be surprised 5 to 10 years down the road how little this might not, these small losses mean to you or to your portfolio. So that's any questions. I think you should have some questions in the chat box session or in the Q&A session as well. Let me check. Okay, let's look at the questions and let me try to answer them. Muhammad, I'm new to investing. I learned that the bear market is the best for shopping. Is it true? Yep, you are right. During the bear market, as I mentioned just now, sometimes things just overreact. People will just sell without any reasoning. Companies which are not supposed to be heavily impacted also face a price correction. And if you are a good value investor, you would be looking at some good deals currently, because most of the share prices of the companies are down. So yeah, you're right. bear market is always a good time for shopping. Jojo, will the market go down further? Haha, just now I already answered. No one will know. Sincerely, no one will know. And I think as of current times, every day you would have new news coming out, and each time a new news comes out, it will always impact the sentiments of the company, of the overall macroeconomic solutions. So news like quantitative easing, news like today, I think a few hours ago, they were saying that there's an asymptomatic COVID strain amongst us. That means there's this special kind of COVID-19 that once people get infected, because their body defense is so strong, the antibody is so strong, so they don't show any symptoms of COVID-19, but they still can spread the virus. So this is actually a very negative news, because people who are strong, they won't show the symptoms, but they react as normally. And once they go around unknowingly, they will also eventually spread the virus to other people, and then this will also further increase the cases of COVID-19. So every day the news, we have new news, and all these new news will eventually determine whether the share price will go down, go up, or go sideways. So we won't know, but we can only time our purchases. Next, if the holding length is 10 plus years, is it better to buy companies with very big sell down that gets affected by COVID, like airlines, or to buy companies with less sell downs but lesser earnings, but earnings not affected by, like Nestle? Good question. I would say that eventually, if you want to hold a company for a very, very long time, if you go back to the slides just now, airlines companies are companies who have their revenues and earnings impacted in the short term, because no traveling is allowed, as we are trying to curb the spread of COVID-19. Of course, when everything goes back to normal, airline business will also continue. People will still continue to go for vacation, and eventually things will normal back. But airline companies are risky in the sense that they are also impacted by another thing called the oil prices. So if you are a fond, or if you look at AirAsia's annual report frequently, you will notice that sometimes every year they are earning more and more revenue. They are increasing their ticket sales, they are flying to more destinations, but the earning does not always tag along with their revenue growth, because a huge chunk of their cost comes from crude oil prices, and crude oil prices go up and down. And if in their annual report, the hedging policy or hedging strategy of AirAsia is they will only hedge 60 to 70%, or maybe 50%, depending on the price of the crude prices or the oil prices, to control or to minimize the fluctuation of the crude prices or oil prices that impact their earnings. So even though things goes back to normal, if your oil prices goes back to historical high of close to say maybe 100 bucks per barrel, then even at that time, AirAsia's earnings will be impacted because of higher crude oil prices. But for companies like Nestle, day in, day out, yeah, they are slow. People would say they are steady, they are very stable, they don't show double-digit growth, but they are indeed a safer choice of investment to look at if you cannot take the fluctuation of a company's price too much. So having a stable company to actually mask out or to narrow down the fluctuation of a very high growth company but with fluctuating price would equalize your portfolio and minimize the share price changes too much in terms of times like that. Okay, let's move on to the next question. So buying banks makes sense. Are there any dividend and capital gains for Hong Kong, Australia, and UK markets? Be it dividend or capital gain investing, both investing methodologies or returns actually make sense. Just because good companies will eventually grow their business, increase their sales and profits, trends along, eventually it boils down to how the company will want to manage their earnings. Would they want to give back a partial of these earnings to shareholders as a form of dividend, or would they want to hold on to the earnings and build more factories, grow further, grow faster, do more R&D for if you invest in pharmaceutical companies, you need to come up with the latest drug, latest cure, and these companies are actually companies who rarely or pay little dividends, but will reinvest their earnings into growing more, invest into growing the company bigger and bigger, so that the company would earn more returns in the future. Next, we have Tyler asking, is automotive shares good to hold now? Automotive shares, it depends also. Of course, in Malaysia, you have a few listed automotive company shares in charge of different brands. You have Burmas Auto, you have companies, UWC also in charge of Toyota. So for me, if I were to look into automotive shares, I would have to look at the current market share of the car brands in Malaysia. What is the most famous brands? Do people go for more? Do more people go for Honda? Do more people go for Toyota? Or do more people go for Mazda? Next, I would also take a look roughly at what are the upcoming models of each car brands. And it only makes sense to invest if the company is having an upcoming attractive model and currently trading at the very low valuation. But personally, I don't look into automobiles because it's cyclical. Sometimes Toyota can come with a better model and UWC prices would be better. And sometimes, as of lately, I think Mazda is the one coming up with the better models. And also, you also have local players like Proton, who last year eventually managed to surpass all expectations because the X70 model was one of the favorite models or one of the hottest models that Malaysians actually love. So you have to take a look at that before you actually invest into an automobile stock. Top Glove is still good to invest. How do you calculate good price to buy a stock? I learned that there is something called intrinsic value, but I can't seem to find the best way to calculate. Can you share to us how do you do it? Should we invest outside of Singapore since there will be forex risk and other returns better? Okay, this is a multiple question. I'll answer it one by one. Top Glove is still good to invest. To be honest, Top Glove is trading at quite a high valuation. Of course, they are still growing. Of course, Top Glove will continue to grow, but it would be very difficult to foresee Top Glove controlling a majority supply versus Hartalega, Kosan, and Supermax. So Top Glove is growing, but all the other glove makers are also growing. So you have to determine how fast Top Glove is growing, and can Top Glove eventually take market share from Hartalega, Kosan, and other glove makers. Only then it makes sense to justify that Top Glove is winning against its competitors or opponents, and current valuation is attractive. So for currently, Hartalega is the most expensive one. Next is Top Glove. If you ask me personally, I would say in terms of efficiency, in terms of margins, Top Glove is still well below Hartalega. So that justifies why Hartalega is so much more expensive. But they are in a difficult scenario. They have a very strong competitor, strong opponent in shape of Hartalega, but they also need to make sure that they eventually don't lose out to Supermax and also Kosan. So personally, I won't invest in Top Glove, but if you have a very, very long hindsight or long investment outlook on Top Glove or any glove manufacturers, you can look into them further. And if your holding time is long enough, and eventually if they grow bigger and bigger, then that's where you will eventually realize your potential gains. How do you calculate a good price to buy a stock? So basically, you can calculate it based on a few factors. You can look at the PE ratio, and for glove companies, like just now I mentioned, you have a lot of glove companies in Malaysia, and you need to justify how come each company is trading at a different PE valuation. Like for example, just now Harta Lega is clearly more expensive than Top Glove in terms of PE ratio, just because they are more efficient, they have a higher margin. Because if you look into Harta Lega, how the management actually built the line, they built the line from scratch. They have the technical know-how on designing the machines, so they are able to recreate a rubber glove or a natural glove plant from scratch. Well, for Top Glove, they have both approach. They do merger and acquisition. They buy up smaller glove factories, and they also build their own plant. But if you look deeper into their outputs per minute by comparing both factories or both companies together, you'll notice that Harta Lega is a very, very lean, very, very efficient company. And if Harta Lega would want to throw price and to scare Top Glove away, you can easily do so, because their profit margin is so much higher than a company like Top Glove. So you have to compare, you have to look at the historical PE, and also if they are same companies in the same sectors, you have to compare the PE within each company. Then you'll make sense to justify that, okay, I'm going to buy this company because even though it's a higher PE, but because profit margin is higher, so it justifies, and I'm willing to hold this company for X amount of years. So that's how you come up with your thesis to invest in a company. Last, should we invest outside of Singapore? Oh, so I presume you're from Singapore. Since there will be forex risk and the returns are better or not? Yes, forex risk is always there outside of one country, and this forex risk would actually be an advantage or disadvantage to you. For Malaysians, we are very well aware that the Malaysian ringgit is always on a depreciating trend, and in fact, we depreciate faster compared to USD, compared to Sing dollar, just because the macroeconomic climate of our country itself. And if you chose to invest outside of Malaysia, for Malaysian, this would actually be very advantageous to you, because if you hold on to your Malaysian companies or Malaysian listed companies investment, of course share price will go up, but you're not in tune or in line with the other companies growth outside of Malaysia. Companies like, even if for Singapore, if you're from Singapore, if you invest in US companies like Netflix back then, or even Facebook back then, the potential gains would eventually cancel out all the forex risk of investing outside of your comfort home or of your home country. So it makes sense to invest outside of Malaysia or outside of Singapore, just to get a more diversified geographical presence in your portfolio. How do you think about performance of bank companies after 6 months payment deferment? Russell, okay, so of course, the liquidity of banks will be impacted since after the moratorium orders in Malaysia. Definitely, banks would be facing some cash flow challenges. I wouldn't say it's a big problem, because they have sufficient liquidity, which they have is like a requirement which all banks have to adhere to ever since the 2008 financial crisis. So after that, there's a statutory law or requirement by the Swiss banks that governs the requirements of all banks around the world, that each bank has to have a sufficient capital buffer on hand to withstand any economic crisis. So they will be facing some challenges, no doubt, when Malaysians choose to take up the moratorium offer. But of course, banks being banks, they will come out with multiple ways to overcome these cash flow challenges. Any other questions? I think we still have some questions. Okay, some of them are repetitive. Some banks make sense. Yep, they make sense, but please do your due diligence. Not all banks are the same. Some banks are facing their respective own challenges. Some banks are poised to take advantage of the current situation. So do your analysis and research well. Are there any dividend and capital gains for HK? Okay, this is a repeated question. Okay. I think Jojo has one last question. or let's go on to, yeah, just Jojo. Is there any capital gains and gain tax for overseas markets? If you are investing in Singapore as a Malaysian, nope. I don't think you have to pay any capital gain tax if you're Malaysian investing in Singapore. You do not need to also pay any capital gain tax if you invest in the US market. But you are subjected to dividend tax of 30% of your dividends. So usually companies in US, they seldom roll up dividend payments because of the huge dividend tax they tax on shareholders. So usually they do share buybacks and that increases the share price. So that's another way of a company returning the favor of an investor to invest in the companies. And I guess that's about it. We don't have any more questions. Or do we have any more questions? You can shoot up more questions. We still have time. Darren, I think we have no more questions. Or is there any other questions?
Okay, okay, sure. Okay, great. Yeah, first, thank you for Joo Parn for today. The sharing is very knowledgeable. I learned a lot from your side. So, if anyone still have any questions, I just share a link in the group chat. The link is a post where you can ask any other questions with Kyle Plus. You just go over to the post and you can just create an account. It's a free our platform is a free platform, so you can just create an account and you can just type in your questions for Kaya Plus. Yeah, they will answer you from there. So I can just show you guys. Okay, so this is Kaya Plus profile inside investing node. You can just search for my Kaya Plus or just Kaya Plus, it will show up. And then after that you can come to this post, and below you can just type any questions that you want to ask them. Okay, great. Thank you very much, everyone. I think today hope you guys learn a lot. Okay, thank you. So we are going to end the webinar now. So next week we are going to have another round, so it will be in Chinese. So I will going to post the next webinar info in our page. So just stay tuned. Thank you very much. I'm going to close this webinar now. Thank you. Bye bye.